families and our lives. On the other hand, hosting almost 300 participants would have not been possible, at least in this audience, nor it would be possible to fly over today's speakers from New York and London just to participate in this event. So there is definitely an upside to this new normal, and our societies are taking first steps in coping with it. And this reality is no different for the private equity industry we're going to discuss today. This pandemic has had a tremendous impact on private equity firms, their portfolios, and their investors. Today, we invited executives from Neuberger, Berman, APG, and Blue Sky Group to share with us their experience and also their ideas for the future of the industry. Please feel free to post all your questions in the chat box during the event, and we'll try to address as many of them as possible. But we start today with our keynote speaker, who does not need any introduction, at least not for the members of the Oxford Business Alumni Association on this call, Ludovic Phalippou, Professor of Financial Economics at Saïd Business School. Ludo, please feel free to turn on your camera and your audio so we can see you and we can hear you. There you are.
Yeah.
Well, first of all, you dedicated over 20 years of your life to research in private equity. You published many articles, books, and blogs, and it's a real honor to have you with us today. Thanks a lot for joining. Let me start with this. January last year, the first information about viral pneumonia was picked up by the authorities and the media. Things moved rapidly throughout February until COVID-19 was declared a pandemic by the World Health Organization on March 11, which is exactly 1 year ago. And many of us will remember March as the month where life changed in Europe, as many countries issued lockdowns amid rising hospitalizations and deaths due to the virus. So let's just start by going 1 year back. How did this pandemic affect you personally, your activities at Saïd Business School, your academic research? What has changed for you?
That would take an entire hour, but it's a very interesting question. I think it's we should communicate more about it as a school, because what we have done at Saïd is dramatic, and I think very good example for many schools. So a lot of schools simply switched to Zoom, and then that was it. At Saïd, we decided to completely rethink, at the same time as we were switching on Zoom, the delivery of our courses. In fact, I had been pushing conversations for a long time. In fact, as soon as I joined Saïd, I wanted to have a partnership with Coursera to develop online courses and things like that. And the discussions had been a bit slow, but they were starting to pick up. So 1-2 years before the pandemic, we started an online executive education program. I put together a private equity course online a year before the pandemic hit, and it was released 6 months before the start of the pandemic. So we had started to digitalize some things. And the view we had was like we wanted to give more digital material to students. And in particular, the view I was pushing for was that we should stop having lectures where we provide information. I should stop having a lecture where I explain how capital structure works. This needs to be taped with video, and this is done once for all. And just like you would read a book, you can watch this video whenever you want, but the sessions with the students need to be Q&A. So students need to watch the information part, and then we have a Q&A, and same for the guest speakers. What I hadn't completely seen, though, is that there would be this Zoom fatigue or this video fatigue of people. And so what I've learned during the pandemic was that actually the winning ticket is not so much the videos, but it's the podcast. because the podcast is something that you can listen on the go. So you can listen to something if you don't need to like make people see something, a concept you're explaining, and you can just describe it in words. Then the podcast is the best because people can run, take transport, like be on the move, cook, do anything while listening to the podcast, and they can really do these two things at the same time. So I think the winning ticket is that we transform all the information part of the lecture, the one-way delivery, into things like podcasts. And in fact, this podcast series I started is basically per item in class, and it is built as if I was writing a textbook for private equity or as if I was teaching my private equity course, and including, well, I'm inviting all my guest speakers basically. And so the idea is that the students can listen to a podcast, and then I invite this guest speaker, but then we start more or less right away with the Q&A. It's like you've listened to the guest speakers telling you what they do in life and so on. So let's start with the questions instead of a guest speaker every time explaining what it is they do. And so Saeed has done like, yeah, a huge amount of things. We had empty buildings. We have a lot of hotel rooms effectively because we have all these executive education programs in residence. We converted that, and then we used it as shelters for homeless and for women who were victim of domestic abuse and so on and so forth. So the number of things we did in that period is absolutely shocking. So while a number of schools simply switched to Zoom and said, like, that's it.
Well, it sounds like it's been a very busy year for you. And actually, I just wanted to also to mention your podcast series. I'm finding to be very interested. For everyone who is not familiar with it, please go to peladbear.com/podcast, and I highly recommend it. To start with some very general questions. As COVID-19 pandemic brought the markets in the first quarter of the last year to almost a standstill, did private equity demonstrate their ability to adapt? What is your take on what private equity was going through in 2020 and how they were coping with it?
Yeah, so these are very interesting questions. That's not my forte. I usually analyze the past with extensive data and enough distance. So the short answer is that I don't know. What I can say from a broad picture point of view is that of all the forms of corporate ownership, private equity tends to be more responsive to things. And the reason for that is that people are so highly incentivized on making money that if there is any problem, they are, usually the first to intervene and react. So that we had some evidence of that in the 2008 crisis, where the private equity owned companies were the first to renegotiate their debt packages before corporates with similar amount of leverage did. And we think that it is due to the incentives that the private equity industry works under that people have been very reactive.
Okay, well, that's on the positive side, but let me also now ask a critical question, because traditionally private equity firms were frequently accused of asset stripping, cost cutting, loading balance sheets of companies with debt. Do you think that this pandemic is going to reinforce this image, or are you observing any structural changes into a different direction?
One thing that is quite funny with researching private equity is that 90% of what people believe is true about it is the exact opposite. So it's quite fascinating. I don't know that many industries where it is that everything is like kind of upside down. Maybe that's why I use Alice in Wonderland as a theme in my book. Stripping assets, first of all, what it refers to is technically selling a division of a company, right? There is nothing wrong with selling a division of a company. And in fact, in most cases, everybody, including the employees, are very happy with their division, being free or being sold on or something like that. So even if we took asset stripping, which is a bad name, but literally we don't really see what would be the issue for society about asset stripping. Of course, if you say it this way, it feels bad, but if it's selling divisions,
it has a negative connotation to it.
Yeah, you're selling a division. Okay, so what? And often you do want that to happen for everyone involved. So it's not really clear it would be bad. And the other thing that is weird is that it's the opposite of what private equity does, because the last 10, 15 years, so not in the 80s. In the 80s in the US, there was a lot of divisions being sold out of conglomerates, but it was not even the case in Europe. It was mainly US private equity industry. And in Europe, it was not really there. And the last 15 years everywhere in the world, what private equity has been doing is what's called buy and build. So if anything, they have added a lot of companies to existing companies. So then, but even that, then lots of people said, oh, then that's good. It's the opposite of asset stripping. Well, hold on to it, because we actually need to think a lot harder about what that means, because this consolidation, which is the nice word to use for it, has consequences for people. We see now, dentists, fitness centers, etc., getting, you have free brands in an entire country. What does that mean for the consumer, for the prices they pay, for competition, etc.? There are some positive aspects, but we need to not be too naive about it and think also about the negative possible consequences of consolidation. So it's quite weird, this thing of like, asset stripping. So the opposite is happening, but actually the opposite is not necessarily that good. And we need to think a lot more rationally about these things. Cost cutting, yeah, it has always existed. Again, sometimes it's good. Usually it does hurt some people. Yeah, so I don't think in this crisis they have cut costs more dramatically than anyone else. I don't think that will be something that will come out. What will come out, however, is the use of leverage. Now, they're not the only one to use leverage, but they're using leverage quite in a rather punchy way. And so now that I think could create an issue, because what happened effectively is that when it is a bit weird that all the countries have this rule whereby leverage is effectively tax subsidized by the government, right? You get a subsidy for using leverage because the interest payment on a capital claim that is deemed leverage is tax deductible, and the distribution on a capital claim that is deemed equity is non-tax deductible. So that is subsidized, and the deal usually is like, well, okay, so, and the leverage effect is that if things go well, then you will make a lot more money than, if you hadn't levered up. But if things don't go well, you're going to be killed much more quickly, right? So a slight downturn can be enough to kill you if you have tons of leverage. So that's usually the deal. Okay. So now what happened in this crisis is that, well, right before the crisis, the guys who were levered and things were going well, there were, it was happy times, or very happy times, thanks to the leverage. And then you have a crisis that, again, just even an epsilon of that should have been enough to kill people that are 90%, 80% levered. And what happened then is that for a while, the first set of rules, the government said, well, we're going to help companies, but only the ones that are not too levered before entering the crisis. And so effectively saying, we're going to help everyone except private equity held companies. Lobbying was successful. It was decided that any company would be rescued. So what we ended up having is that then you have people having maximum leverage. Then if things go well, they are very rich. And if things go bad, the taxpayer is picking it up. And that I think that, when we will be counting sheep after the crisis, this is going to be part of tensions that will be out there, alongside massive inequalities. Because what has happened is quantitative easing has not only favored the private equity industry, but most generally has favored tremendously asset owners, the wealthier asset owners, and the other people, like people working as nurses and school teachers, etc., their pay has remained constant throughout, and if anything, they have suffered a bit. And so that I think is going to be then a very big issue, and the fact that private equity was these highly levered people that then make tons of money, things go well, and then were rescued, is probably going to be a source of tension. And what makes it even like more dramatic here is that private equity is, roughly speaking, investing in 3 types of industries. And that's also a new phenomenon. So in the 80s, 90s, 2000s, there was no tech in private equity. There was a bit in venture capital, but it was less than in buyouts. So tech was a relatively small fraction. Nowadays, there are tons of 1/3 of buyouts are in the tech space. So a lot of private equity in dollar amounts is in the tech space. And all these investments have done amazingly well during the crisis, just like any other tech companies. So these guys were highly levered with tech in it, just go through the roof, make tons of money. And the guys, and 1/3 of industries in things like retail, leisure, like, these sorts of space. And these people should have been wiped out in one sec, with just even like a crisis would have been 1/10 of that magnitude. In the UK, almost every restaurant chain is held by private equity. So you shut down restaurants, like these guys should die in a week. and then they get rescued, so they're fine. And maybe they will be hurt when it reopens, and they will not quite recover, but so far they're fine-ish. And then the other third is like healthcare, and then in healthcare you have some who benefited and some who were hurt, right? So because you have a number of healthcare things like, I don't know, cosmetic surgery or things that people didn't quite spend money on during the pandemic, and so but some other healthcare things did well. So that I think will come up as a question. The question of taxation inequalities have been magnified in this crisis. It was already big walking in, partly because of the quantitative easing effect. Now this crisis just multiplied it by 10, and it's amazing. Like people who are working in practical industry, the funds that are more into retail leisure are just okay, but all right overall, and the ones in the other sectors is just huge paydays, etc. And people are going to be very upset. So they don't see too much. Most of it is kind of hidden. But I don't see how this is going to be sustainable. And I'm extremely concerned about stability in general. So far, I guess people have worries. And maybe once we open up, people will be so exuberant and party, and they will not even question anything. But sooner or later, people are going to ask about these massive inequalities that have been created.
Yeah, absolutely. And we'll see how it play out. But it was a very, very neat summary of what's going on indeed. A different question. As private equity firms are looking to create and preserve value, they might also look at the strategies that work and did not work during this pandemic. As the Warren Buffett famously said, it is only when the tide goes out you discover who has been swimming naked. In other words, this crisis should help private equity funds to identify if the management of their portfolio companies was fighting for survival, or if they were really trying to capitalize on changing market conditions and were successful in it. So are these winners and losers already emerging? Do we already know what type of behavior generated high performance, or is it still too early to say?
No, I think that by and large, it's an industry effect. The winners are people who are in tech. The losers were people who are in retail and the like. And I want to take the opportunity of this question to highlight something that has been said during the crisis. That was that if you behave well, if you like ESG friendly and so on and so forth, you did better during the crisis. I think this type of reasoning, and I have a video on YouTube where I give my views on ESG impact space, it's extremely counterproductive and dangerous. The reason companies that have high ESG scores did well during the crisis is because somehow people rated companies that were in tech as ESG friendly and rated companies that were in oil and the like as ESG unfriendly. And during this crisis, anybody in oil has been hurt because planes stopped flying and so on and so forth. So that's it. So it's an industry effect. So same thing here. You could say, oh, there are some funds that did better during this crisis. These are funds that were nicer to employees and so on and so forth. This will be epsilon compared to the industry effect. It's which industry you were in that dictates how well you did during the crisis. Maybe we will manage to tease out in the data how at the margin you treated employees or things like that helped in that space. I do have an exciting paper on that coming up. I don't have enough data yet on during the pandemic, but we are doing a study where we have like 4 million reviews of people of employees of their employer, and we look at how it differs for practically health companies versus not. And so as we will update the data, we'll be able to see as well what people said during the crisis if their employer was a practically versus someone else. But something else that my research experience has shown and comes out in this paper very clearly is that the private equity industry is often portrayed as something homogeneous, and it's really a tale of two industries, like for what I saw in many papers. It's that on the one hand you have the people that I would call cowboys, it's a world where there is no regulation. You can get away with tons of stuff, and yet some people just behave very, very, very widely, and they are there to make as much money as possible, and they would do whatever it takes, and don't care about anything else whatsoever. And then you have another set of private equity firms who are very serious people, who know how to run companies better, help, are kind to employees, and so on and so forth. And so we need to be careful about talking about private equity as a one entity. There is massive dispersion in habits, and people moving from one to the other. Some people who maybe started as nice when they were small, as they become bigger, becomes more and more cowboy-like. So that's important to bear in mind. But for the winners and losers, the industry is going to drive all the effect. Like 90% of the effect will be an industry one.
Interesting. And something else here, because we all know that this pandemic redefined the way we do business and the way we live. We've seen basically this whole world moving to the digital environment with remote working, online shopping, etc., becoming our new normal. And most likely we're not going back to the pre-pandemic situation. What does this mean for private equity industry? Is the pandemic going to redefine the industry for good, or do you think that we will go back to pre-pandemic business model structures and practices? Is there something that is going to be different?
I don't think so. I mean, maybe people will have less face-to-face meetings and be a bit less obsessed about like traveling around the world for one meeting, which would be a good thing. But overall, I don't think it would change much. It's very different from 2008. In 2008, really, like people were on their knees, and you had the balance of power went from being all into GP hands in 2006, 2007, to being like in LP hands. So the pension funds were in a stronger position. The endowments were in strong positions when talking to fund managers in 2009, 10, and 11. And we saw lots of concessions on fees. We saw contracts that were written a lot more cleanly. We saw people starting to question a lot more hidden fees, all kinds of things. And so we saw ILPA picking up things and really getting some traction where they never had any traction until 2009, 2010. So we saw some real changes after 2008 because the fund managers were on their knees, basically. On this crisis, it's party time. Like these guys are doing extremely well. Money is flowing all over the private equity industry. So there is absolutely no reason to change anything. If anything, it's even more of a party than it was in 2018 and 19. So it just will continue going. There is nothing. It didn't hurt that industry. If anything, it helped it. So you could say, for the hospital industry, they may need to rethink a few things. But here for private equity, it's like, so it's very different from 2008.
Well, I think now is a good moment to bring those industry experts into this conversation and continue with them. The first I would like to introduce is Dick van Lomwel. He's the head of EMEA and Latin America at Neuberger Berman, the firm who was, one of the first financial companies back in the 80s to launch the fund of funds, and today has over $100 billion of assets under management in private equity. Welcome, Dick. Thanks a lot for joining from London. Great to have you with us. Let's start with a very brief introduction to the audience of the capabilities of your private markets platform. What type of private activity are you involved with, and which investor needs are you addressing?
Well, first of all, I'd like to thank you for organizing this. It's really nice to be asked, so thank you for that. It's also fun to be back in a Nyenrode setup, because I remember going there with my dad in the early 80s. I'm a very old person, and I ended up studying in Groningen, but I remember how beautiful that castle is, and it's a bit of a pity that we can't be there live now. But anyway, on a serious note, so Neuberger Berman, a very quick sort of intro. It's a private firm, 100% employee owned. At least in the Netherlands, folks can pronounce it. In Asia, we go with NB, but we're clearly not a household name. Overall, we run about 400 billion, and of which about 100 billion is indeed in private equity. So thank you. That is a combination of fund of funds, which is roughly about 1/3, to your point, on the early roots of the private equity franchise, and the rest is, and of that, of which part of it's primary, part of it's secondary, and then we have 2/3 of our 100 billion is in more sort of specialist strategies. Could be direct and co-invest, it could be private debt, and special strategies such as drug royalty, brand royalty, or taking stakes in hedge funds and GPs of private equity. Overall, we sit on about 230 advisory boards, invest in 500+ funds, so it's quite a helpful network. Some 250 people overall involved across the business out of 2,200, and we allocate about 10 billion in private equity a year. So I think that makes us pretty relevant. Not that size matters, but it's relevant. Europe is important to us. We have offices in most countries, including the Netherlands. We have a big office in The Hague. In Europe, we manage about 60 billion, of which 1/3 roughly is in private equity, and Holland about 9 billion, of which about 1/4 is in private equity. So, and lastly, it's largely an institutional business.
Well, it sounds like you work a lot with institutional investors across the world. So let me ask you this question. What is the current mindset that you observe among institutional investors? Are they bracing for increased volatility, downgrades and defaults? Or is it for them the once in a lifetime opportunity to go shopping for distressed and undervalued companies?
Well, the institutional clients we deal with are not very tactical or opportunistic. They tend to work ALM driven, almost like super tankers. So what we've seen, and I agree with Ludo, there's a huge amount of demand for private equity services. I don't agree with Ludo on many other reasons, but let's not go there. It's the point is that the typical private equity firm is benefiting from all the institutions who are increasing their allocation, and in many cases just starting. So where, for instance, private equity 15, 20 years ago was perhaps a hobby horse of a CIO or a CEO at a pension fund, now it's a strategic allocation between 5 and 25%. And this is not just a developed markets, large institution thing, it's also across Asia and Latin America. To give you an example, we're currently working with some of the Mexican Afores on their allocations, which is quite exciting. What's also worthwhile mentioning is that these are incredibly sophisticated institutions, and the conversations are sort of as such. So it's they typically revolve around knowledge transfer. They revolve around educating their staff also on the legal and the compliance side and on the back office side. So investing in private equity is a completely different ball game from investing in public funds. And the other thing related there, because when you partner with a private equity firm, it is good or bad for the long term, because these are 7 to 10 year commitments. So you better make sure that everything works well and that the cultural fit is there as well. So so in short, to answer your question more directly, we don't see a lot of let's sort of dial up, let's say, distressed debt, or let's dial down allocations because we feel valuations are high, because most of our clients, they appreciate that private equity investing is a program. It's best to do it over many years, to commit to spread a commitment, because each commitment again will be spread over many years by the underlying funds. So it is not something where you can be tactical, because even if you had a view on, let's say, I want to be overweight in Asia distressed, then you have to have that view for the next 7 to 10 years. It's not something that you can exit. Although having said that, and then I'll shut up. Having said that, we do see an increased number of clients who are using secondaries as an opportunity to fine-tune and make tactical shifts, but that's still very small.
Okay, and I'm sure that all these investors you deal with, they are coping differently with the crisis. But one thing they all should be working on are their value creation plans. Are you seeing investors asking themselves, given what happened with this pandemic, are things that I underwrote when I did this deal still true? Are the fundamental underpinnings of what this business needs to create value still relevant? Are the investors asking these questions to themselves, what can you say about the defensive and offensive actions of investors you work with?
Well, look, I think the COVID crisis was a big tragedy, and we all in the financial industry, we've been incredibly lucky and fortunate that we're able to cope and work remotely. So clearly, one of the first things we started doing internally and we started doing with our LPs is over communicate. So I think the best thing you can do is make sure that you're completely, as say, open kimono with your clients on what's working, what's not working, because that gives a level of confidence. It goes back to the partnership that you should have with your as an LP with your private equity partner. So that helped a ton. I would also say, and that's and funny enough, I was reading some research from one of our competitors. They had the same experience, that overall the impact of COVID has been relatively limited on our portfolios, and that's not just a marking delay element. That is just frankly a function of underlying companies coping, and in some cases being supported by the government, in some cases debt being available, in some cases it's just a matter of not being exposed to the hospitality or the travel industry. So let's bear in mind that the casualties were, or the casualties of this crisis were pretty, I'm not saying obvious, but there's lots of industries who did okay and coped whilst not ideal. So I think overall it's been it hasn't been so much a trigger of, oh my goodness, unlike 08, where there was God, this should never happen again. What on earth was happening here? This was a very much an external factor which has massive ramifications, but not I should be managing my portfolio differently. Apart from the more pragmatic things like how do I do diligence on managers, how do I do reviews of companies remotely? That's kind of a more banal point.
Excellent. Well, let's now hear from our institutional investors. We invited to have the discussion today. Let's start with Greg Jania. He's global co-head of private equity at APG Asset Management. Greg, thanks a lot for joining from New York at such an early hour. It's a pleasure to have you with us. For the benefit of those who are not familiar with APG's private equity investments, could you give a brief overview of your activity within the industry and how your portfolio looks like?
Sure. Thanks, Catherine. Happy to join. Thanks for having me. Our program is around 35 billion euros of NAV and about 15 billion of unfunded. We invest across the globe and across sectors, including funds, co-investments, and secondaries. And we have around 42 people in our team across 3 offices, globally. We invest around 8 to 10 billion euros per year to achieve our targeted AUM, which is 6% of our clients' AUM. So APG is one of the larger investors, single investors in the world, versus maybe some of our fund-to-fund colleagues. But we're one pot of capital, which has been a great benefit for us over time. It was interesting to hear Professor speak earlier, because I think I need to develop a new test to test for cowboys in the industry. I don't have a cowboy test yet in my underwriting, but I think it's a good point. I'll have to figure out how we can test for that and underwrite cowboys as we move forward in our program.
Excellent. Greg, what is your take on what happened with private markets since the pandemic began? What have you witnessed? What were your biggest lessons learned and eye-openers so far?
Well, it's interesting. There was a lot of concern early on in people's portfolios because the markets turned down so quickly, and it led to a cessation of activity. If there was, very few, co-investments and secondaries being done right after the pandemic hit, because people didn't know where things were going. But it was one of the most rapid turnarounds as well. So between March and May, co-investment and secondary activity almost halted, except for some rescue capital transactions that we looked at. But the regular co-investments and secondary activity really dropped off the face of the earth. But it rebounded very quickly as the markets came back, given the stimulus, from the governments, across the globe. What we learned in those first few months, though, on the fund investing perspective, was that a lot of other LPs, unfortunately, were worried about, had problems in their internal portfolios, whether it's their public portfolio or alternatives. some people really pulled back from investing, and the last thing they wanted to do was to go to committee to put more money, more dry powder in the market. At that time, they were more worried about having capital available and cash available to rescue other more liquid investments in their portfolio. So we fortunately had a longer term view, and I guess probably had a little better cash positioning as an organization. And so we took advantage of that and actually put more money in certain funds that we would like to have more capital to, and use the pandemic as an opportunity to get more exposure to a handful of managers that were in the market between April, in May and early June. But unfortunately, that too turned around. So by June, July, August, most LPs were back fully committing to the asset class, and hard caps were being tested and even looking to be increased. And so we saw this feeding frenzy for allocation of private equity that Professor mentioned came back quite a bit in the third quarter, definitely in the fourth quarter. We've seen basically return to normalcy and the upper hand going back to the general partners, on negotiations, fund sizes, etc.
Yeah, it's been a very exciting year for you, I guess. Let's just talk in a bit more detail about your investment and asset management activities. So on investment management front, what can you say about the market dynamics starting from the beginning of the lockdown? Did you push the pause button on all your activities, or have you had your best year ever in terms of deal making?
Yeah, it was our most robust year in terms of number of deals and capital deployed. Because there was a shortage of capital early in the year, so we were able to take advantage of that during the downturn to get a few more deals done than average. But coming out of the crisis on the co-investment secondary side, there were people who decided to lighten up on their activities in secondaries. We took advantage there. There was a few investors that were looking to kind of move more assets in the public markets instead of private assets. We took advantage of that in the secondary market. And then when it came to co-investing, there was a rebound in transactions, and there's more GPs these days that want to go it alone. They don't want to partner with other GPs. So we saw some large transactions emerge in the back half of the year that allowed us to put much more money to work in co-investments. So for our team, it ended up being our biggest co-investment year on record, and our biggest secondary year on record. And the fund's activity stayed relatively normal. We were at target, but we exceeded our target on the co-investment and secondary side in terms of number of deals and total dollar or euro amount of deals.
And on the asset management side, is this pandemic changing how investors such as yourself and the GPs are managing their portfolio companies? And also, going back to Ludo's comments about, potentially emerging winners and losers, what is your experience so far?
Well, as I think was mentioned earlier, there's been a big exit of asset classes like offline retail and energy, and a big increase in assets going into healthcare and technology. And our portfolio is relatively young, so we only started investing on an in-house, from APG's own balance sheet in 2012 and 13. So our portfolio already had the characteristics of being, probably, overexposure to healthcare and technology in general, because we didn't have a legacy portfolio that might have had more retail or energy in it. Also, given our APG's, ESG concerns, we were underweight energy compared to most other asset class, most other investors. So at the start of the crisis, we had less than 10% of our portfolio, I think less than 8%, in energy or retail. And so those industries were the hardest hit throughout the first, 3 months in the last year. But we had a relatively small part of our portfolio there and affected there, and we're more exposed to healthcare and technology, and again had a bigger increase in those portfolios in the back half of the year as well. On the portfolio management side, we were pleased to see that the general partners generally took a very active approach in being transparent with the LP. So we saw very much an increased communication cycle, using Zoom and other technologies, webinar teams, to have more and more frequent dialogues on the status of their portfolio. So we never felt like we were behind the curve on knowing what was going on. We would get pretty frequent updates from our 90 GPs in our portfolio, and even in some cases having weekly updates with members of the deal teams at the GPs to hear how things were tracking, where leverage was, covenant violations, if any, traffic, all that. So we thought it was actually a good good to see the GP step up and increase the communication and transparency during the pandemic. Because that was so much additional work, we're seeing a pullback in that frequency of meetings because you really can't handle that many meetings when things start going better again to some extent. We've got our normal work to do, new investments, but I did think it was a good thing to see the GP step up, provide the extra communication and dialogue with the investor base to make sure we felt connected and included in knowing what was going on.
Thanks, Greg, for now. I now would like to introduce our second institutional investor on the call, Marc Roijakkers. He's the head of the Global Alternative Investing at Blue Sky Group and is also a board member at Invest Europe, an organization that represents interest of private equity and venture capital investors in Europe. Thanks a lot for joining, Marc. Let's also start with a very brief introduction of Blue Sky Group's alternative investments platform, and more specifically, what kind of private equity programs do you execute for your clients, Dutch pension funds?
Thank you. Well, it's a bit similar to Greg's story. We initiated the program in 2012, so it's still fairly young, but it's equally diversified. It's a global program focusing on secondaries, primaries, and about 3 years ago we added co-investments to the program as well. And it's about roughly, we manage a bit north of 21 billion euro, and we allocate about 5% towards private equity. So currently we have about 1.8 billion in commitments and about 1 billion in NAV.
And what challenges and complexities did your private equity business have to navigate through during the pandemic? What was your experience similar to Greg's?
They were more or less similar. So yeah, they were more or less similar. So we started once again 2012. Ever since private equity had great tailwinds. So our clients reached out and asked, okay, what can we expect will be the impact on private equity? So we reached out to the big fund of funds, a lot of our peers who had been in the S class for many years longer. And as a result, we anticipated that there would be a drop in valuations, about half what we saw on the public market, that we expected a full stop in liquidity, no new investments, no divestments. And we would expect fundraising to stop as well. Well, none of the above happened actually. It happened only one quarter, but ever since it has more or less been busy, business as usual. Even though I would dare to say that on the co-investment front, the third and fourth quarter were exceptionally busy. Yeah.
And how resilient were your models throughout the lockdown period? Were you eventually able to steer portfolio companies into safety? Or were your investments, less affected than you have initially anticipated?
Well, first of all, they were much less affected than we anticipated. And it's an equal story. As we started in 2012, we have less exposure to energy and offline retail, much more exposure to technology. And that, of course, is in great shape. And once again, we were positively surprised by how proactively all managers reach out, giving us indeed weekly updates what was going on. But second to that is if you see how liquidity came back to the portfolio, particularly on the technology side, it's on an exit mode. You can argue a little bit that is fiscally driven in the US with a new government in place, and there's talk of a different taxation. But we have seen a strong portfolio. Yeah, absolutely. And fundraising, it's been as busy as ever.
Well, I'm only hearing the very positive sounds thus far. One of the areas that is seeing an interest from private equity investors is ESG. Ludo just mentioned that, and especially institutional investors are looking to increasingly looking to apply their ESG principles to the portfolios. Marc, how important is ESG for Blue Sky Group, and how do you put this in practice in private equity? And lastly, has this pandemic sharpened your focus on corporate and social responsibility?
So first of all, ESG has become more important in the last couple of years for our clients, and hence we have to implement it across the asset class. But here's the challenging one: as we invest globally, I think the it were the Dutch and it were the Nordics that pushed for LPs, that pushed for ESG measurements within private equity. I think the large cap managers, they started implementing that rather quickly. But if I travel, when it was still possible to travel in the US, and you meet mid-market managers locally who only have US investors, last couple of years, a lot of people, first of all, they raised their eyebrows. Okay, what are you asking for? ESG. No, we're not a UNPRI signatory, for instance. But then you go in depth what you're looking for, and then they say, no, listen, we don't call it ESG. We've done so, and it's part of our due diligence on a portfolio company, but we never labeled it as ESG. So personally, I think that the industry is further ahead than a lot of people think. But yeah, indeed, private equity is, I think, the asset class where ESG can be implemented actively due to the way GPs run their portfolio companies. But it's a dialogue we constantly have, but it's also a dialogue you have to monitor, and you have to keep guidance to your clients as well, because not all managers, particularly the smaller ones, are, for instance, UNPRI signatory, because it does come with a lot of compliance.
Greg, let's get you back now, because I have a similar question to you as well. I think it is safe to say that APG has always been at the forefront of applying their ESG principles to their investment process. Can you tell us about how you put your and your clients' ESG ambitions to work in private equity, and also if this has changed, if at all, throughout the pandemic?
It's a great question. APG does want to be, and we try to be one of the leaders when it comes to private equity and responsible investment guidelines in the asset class. We continually look to, move the goalpost actually for our clients to make it harder, make it more and more difficult to add things to our goalpost and what we expect from our private equity managers. We were one of the early people to push for diversity reporting from our GPs. We're also adding quite a bit now on the climate risk policy, making sure our GPs are thinking about climate risk in all of their investments, even though in PE, the hold periods tend to be less than 5 to 6 years. We want our GPs to think about the climate risk, even if it might affect those companies longer than their hold period. So those are some things we've been adding in the last year, especially is on climate risk. We have actually passed on and not re-up with many managers that didn't evolve with our ESG program. We've had strong performing managers, mainly in the non-European arena. So in the US and Asia, ESG is evolving a little bit slower. And even though managers, we think they're paying attention to ESG, we expect reporting on KPIs from our managers on each company when it comes to ESG. And some people aren't evolving that quickly. We don't require UNPRI signatory, but we do expect them to report on ESG at their portfolio companies, ESG incidents, any reputational incidents to us. And some managers just aren't moving that quickly. So we have had to pass on several managers, especially in the mid-market across the US and Asia, that were very strong performing funds. But that's just a seriousness that our clients want us to take when it comes to ESG. Hopefully those managers will come back, and improve their ESG standards over time to match ours. But APG is not standing still when it comes to ESG issues. And like I mentioned, climate risk is one of the newer ones we're pushing very hard now for GPs to think about.
Thanks, Greg. Well, I think enough backward looking for now. Let's now focus on the future and economic recovery. And Ludo, I would like to get you back if you're still around. So this is not the first disruption in the model world, right? We had a Great Depression, 2 world wars, and of course the global financial crisis, where we saw private equity multiples in some industry snap back quickly. In other, it took up to 10 years, and in some, they have still not recovered. In other words, their P multiples have been re-rated downward for good. Will the same dynamics unfold in the recovery from this pandemic, or will this time be different?
Again, yeah, there has been no crisis in private equity, so it's not comparable to World War or 2008. There's no problem for this industry. So again, except if you are loaded in energy and the like. So I don't think it is any sort of drama. But people might get upset at the fact that the government have rescued a lot of these investments that are highly levered. There would be I'd be happy to give a talk at another time on how to distinguish cowboys in the industry. I have plenty to say about that. Yeah, no, so I think this crisis would have very little effect. The trends will continue. There will be more and more funds focusing on impact investing. There will be more and more talks about ESG, like just the trends that were there before the pandemic will just continue as if nothing happened.
And so we are now at exactly 1 year into the pandemic, and analysts are still undecided about the shape of the recovery curve. You know, K, U, V, W. I think I've seen almost all letters of the alphabet passing by. Well, first of all, for the students on the call and also, you know, non-private equity experts, why are there so many discussion about it? Why is it important to know which curve is it going to be? And what is your idea on the potential shape of economic recovery?
Well, so if anything, yeah, it's the letter K, I guess, because you have some people did extremely well. Again, everybody in tech related, and people who didn't do well are, you know, again, leisure and energy. So, but for the people in energy, I guess they will not really recoup from it. But the ones in leisure, for example, yeah, what I would expect is once these restrictions will be lifted, people will go even more to restaurants than before. So there will be a slight recovery there. And given that, you know, the government picked up the bill partially, fully, depending on the countries, for during the pandemic, so these guys will do well. But you have all the people that you know have done well throughout the crisis, and it's a very large number of people. We should not forget that.
Greg and Marc, I invite you to join, and for everyone just to keep their camera on. Do you share this view? And also, for which type of economic recovery are you preparing your investment activity and portfolio companies? Whomever wants to go first.
Yeah, thanks. I'll go first. I mean, we're being more selective, I think, in our co-invest portfolio for the most part, and even our secondary portfolio. We view those as more opportunistic in nature, where we can actually choose where we want to add our exposure. On the fund side, obviously, you need to pick the best managers who can hopefully perform in all cycles. Historically, and it's hard to go back and forth, go out, leave a manager and come back. So we try to pick managers there that we can consistently back or hope to back. But on the secondary and co-investment side, you know, with the prices we have to pay today, we're being very careful that we back resilient business models, and we're probably seeing a flight to quality. So we'd rather pay up for a quality business than try and, you know, find value or turnaround in this market. So I would say we're upping our quality game when it comes to buying secondary stakes. And the co-investment side, you know, focusing only on quality. We turn down about 75% of the co-investments we see, and even though I think our purchase prices are increasing a little bit, we're happier with the portfolio and the resiliency of the portfolio and paying up than we are looking for value in this kind of market.
Yes, well, it's equally, it's more a bottom-up approach, looking at the opportunity by opportunity, but particularly as the majority of our program is in fund investment. To us, is to get a good understanding what's the value creation plan of a manager, and is that sustainable for the foreseeable future. If it's only a leverage game, but I think those days are way behind us. If it's only a leverage game, then it's definitely a no-go with the current high price environment. You need to have managers that are able to create more value and that underwrite their deals with a contracting multiple rather than a expanding multiple. That's important to us, but it's a bottom-up approach.
So another question to you both, Greg and Marc. So according to Perkin today, private equity firms have about 5.5 trillion of euros assets under management, and the industry sits on roughly 1.5 trillion of dry powder, and private equity funds could very well start deploying the distressed and other opportunistic assets starting from now. Are there any signs of economic recovery? Are you seeing the M&A activity resuming, or are we not out of the woods yet?
I think we're seeing quite a big increase in activity. M&A, add-on acquisitions, the volume of co-investments we're seeing all point to activity kind of back on the kind of straight line we saw before the pandemic. And I would say, even though the amount of dry powder seems to be increasing, our funds that are coming back to market much faster than we expect. So we're actually seeing more capital calls, more frequent capital calls, and the fund cycles shorten. So even though GPs have usually 6 years to invest the capital, I mean, 90% of our portfolio is raising new capital within 3 years, even as the fund sizes are increasing. So we're not seeing a deployment issue yet. It can cause a concern for us as more and more of our portfolio has been deployed at higher prices. So we've got that concern, obviously. You know, if rates and easy money go away, that's going to really affect valuations. That's where we're hoping companies will be able to grow out of that issue with a longer hold period if they have to. But we're not seeing a slowdown in deployment at all.
No, perhaps a remark with regard to the dry powder. So yeah, you do see a lot of statistics, and it's always on top of mind of institutional investors. A lot of people worry about it. But personally, I think the wall of dry powder is much bigger. And to give you an example, yesterday we had an update call with one of our managers. They're working on a new investment. It's an equity ticket of 4 billion. They are willing to invest about 600 million, and the rest was syndicated, and it took them less than 6 weeks. So that does show you how much money is available from institutional investors. Do you worry about it? Yes, of course. But you can also look at it from the positive side. This is a safety cushion. That means that valuations won't drop dramatically due to the fact there's so much dry powder available for these investments.
Ludo, any thoughts from your end?
No, I agree with everything that has been said.
So there is another topic I would like to discuss, very briefly touch upon before we move to questions from the audience. Dick, and maybe you can join us now as well. So various studies among institutional investors show that, everyone is looking to increase their investments into alternative assets, for well-known reasons, search for yield, etc., etc. As a result, the size of those funds is, mushrooming. Just think of Blackstone collecting 26 billion of committed capital to their capital funds, 8, a record for private equity industry. So what are the implications of this trend? Is this going to result in disappointing returns at some point? And generally, Dick, what are the broader trends you see with clients allocating to private equity?
Well, just as it relates to the fund sizes, I'm sure Greg and Marc agree that it's a fund that is a lot larger than its previous vintage is a cause of concern, mostly because of this sort of strategy creep, and are the partners, is a GP actually equipped to, are they moving into a new territory? So that's something that, of course, we are not overly keen on. Having said that, we all talked about a dry powder. We all talked about the institutional uptake and becoming more of a strategic mainstream asset class. It does mean that there is just more money going into the asset class. There's also an element for the newer entrants, let's say sovereign wealth funds in developing countries, who they write very large tickets where they cannot be more than X percentage of a fund. Secondly, they take comfort out of let's say, buying IBM, i.e. going with some of the big guys. So I can't frankly blame some of our large competitors to come out with very large funds. And it's also, to Marc's point earlier, I mean, the deal sizes are also a lot bigger. So it's kind of what you expect, but it's not something we're excited about. I know my fund of fund colleagues are taking it as are cautious with these sort of larger fund sizes. And we tend to focus on the smaller ones, and also in our own funds we tend to have smaller, try to go more gradual as we go along.
Yeah, it's probably one of the biggest issues in every underwriting we have because of the increase in fund size. If you're a successful manager, you're looking to double your fund size, if not more. I would say though that I think a lot of it's around expectations. Even with larger fund sizes, Blackstone in particular has been able to generate returns, that are far surpassing, public market returns. So I think if you're expecting these $25 billion funds return 30% IRR, or 3 times your money, you're probably mistaken. That's your own fault. But if you're expecting to get kind of low to mid-teen returns, 12 to 15% net returns, and that's in your asset class, that's what you're looking for, then you probably will be happy with what Blackstone will provide you as an investor. So it depends on expectations. Some people just think that, well, the last fund or other funds are doing great returns, that's going to continue forever. But I think that's an expectation mindset. Blackstone, any fund that went from $1 billion fund or $500 million fund to $5 billion or 10 isn't going to be able to have the same performance generally they had 10 years ago. But if you expect it, that's probably your fault, not the industry or the manager's fault.
Well, let's now address a few questions from the audience before we move to final thoughts. And Ludo, I think there's a question that just came through from Arthur Gopak, relates to one of your remarks. Privatizing profits and nationalizing losses. This sounds like 2007, 2008 all over again.
Yes, fair enough. It's true. It's true. It's what's happening, right? So yeah, and there was a bit of anger after 2008. I think there will be a bit of anger this time too. And if anything, it's more than in 2008, because in 2008 at least there were some people who got away with it, but it was a limited set of people. This time is like the increase in inequality is massive. It's hundreds of thousands of people whose wealth has increased dramatically during this crisis, and it's millions of people who have suffered dramatically financially and otherwise during this crisis. At least, in 2008, it was like, 1,000 bankers or something. Here we're talking about hundreds of thousands of people who benefited through the crisis.
Any thoughts from other panel members? Anything? Well, there's also another question, and perhaps you can address this one as well, Ludo. So the question from Felix Langhorst, you mentioned quantitative easing and positive effects it has on private equity. Do you also see a negative effect of companies enlarging their leverage due to the low interest rate?
Well, yeah, so the usual concern for high leverage is that if there is any sort of small shocks, then you cannot absorb it because you're highly levered, right? That's the definition. But if the taxpayer keeps on paying up each time, there is a downturn, then there won't be any negative effect except for the taxpayer. So that's a concern. But this concern is not just for private equity, because corporations have been borrowing like mad during this crisis. So it's a general concern about all these people that are like super highly levered, not just private equity anymore. Like all the many corporations are max borrowing. That's not good for stability of the system, because we don't have bankruptcy procedures that are very efficient, and that it's not working with bankruptcy procedure. So.
Well, and the one big thing I would say, and it goes to that, some of these thoughts, is that there's a lot of GPs out there, even LPs, that really think that their managers are all brilliant and all these guys are creating alpha. There's been a lot of beta in the system, and people are confusing beta with alpha these days. And managers who think they're brilliant probably aren't as brilliant as they are, and the ones who aren't doing as well probably aren't as bad as they look. But it goes to this whole point on using leverage and taking advantage of technology and healthcare and valuation uplifts and everything else. But I think a little bit of a come to Jesus or rebound in the marketplace or decrease in markets would help you kind of show that this lowering tides would help a little bit. But there's just a lot of GP arrogance that they think they're all creating tons of alpha for us, but it's probably a lot less alpha than they think.
Yeah, perhaps to add to the discussion on leverage, which it has always been around, of course, in private equity, but particularly the last couple of years, you see an increase in the use and abuse of these subscription lines, whereby capital is not being called. They have a facility, and then, of course, it's a great boost for IRR, but it does make it a challenge to compare apples with apples if you look at funds that apply the leverage on fund level and the ones that don't, or at least are more modest about it. So it has become a And it is becoming a more increased challenging industry.
Thanks, everyone. I see a massive number of questions coming through. I'm not sure we'll be able to address them all. Maybe just one or two other ones. So a question from Nicola Jordan. Does a flight to quality mean giving up on growth projects, or will high quality companies be able to grow valuations?
If I look at our portfolio, we have exposure indeed to, let's say, the growth tech companies, and there you will definitely have winners and losers. But we also have exposure to managers that perform turnarounds, perform complex carve-outs. So you have a multiple of strategies in private equity, and we allocate to all of them.
And then perhaps the last question before we move to final thoughts. So given the performance of tech and emerging tech funds in comparison to other sectors, do you think private equity as a whole is overweighted in tech? Are we experiencing a tech bubble? Do you see a correction of any sorts in the near future? I have a question from Gregory Vogel.
It's a question I've raised this week because I'm in the cycle of having the update with my managers, in particular one in the US in technology. That's the question we raised as well. Where are we and what do you anticipate? But in all honesty, we've been having the discussion for, let's say, 6 years with those managers. And 6 years ago, we were concerned about pricing. Nowadays, we are still concerned about pricing, but they are able to navigate.
I think the time has come to wrap up our discussion today. We metaphorically call this event a tea leaves reading to discuss what the markets are telling us about the future state of private equity firms and their investors. So, Dick, let me ask our last question to you first. How can investors prepare their portfolios for the extraordinary uncertainties of the post-vaccine world that lie ahead?
In all honesty, I go back to my slightly boring point about. Can you hear me? Okay. Yes, you can. Think you can.
Yes, I can.
A slightly boring point about being a diversified and across cycles, because I think unless you are staffed like Greg and some of the other larger institutions, it's very difficult to do co-invests and do secondary, be very nimble and do almost like a top and tail your portfolio as you go along. So for those institutions that are a little bit smaller, we recommend to have a long-term commitment and a long-term program. So don't be nimble. One point I'd like to make quickly while I have the floor is, I mean, maybe COVID inspired, but also climate change. I'm delighted to hear, and APG has always been a tremendous leader in this field. Unfortunately, there are not that many LPs that are really driving this. We see that on the public markets, there's a huge push, and it's almost like a hygiene factor now in Europe to be ESG, or it's almost like greenwashing, as we all know. But on the private side, I mean, I can tell you, we've done a bunch of things like sort of a fund that focuses on emerging managers and on diversity. We're launched our climate involves our impact fund. And it's still relatively difficult to get LPs, institutional LPs, to really spend time on this. So I think particularly given the stuff that's going on sort of the bigger stuff in the world, like I said, climate change and things like related to COVID. I mean, I think the private equity sector has a huge opportunity to get involved in sort of innovation and early stage VC. So VC, as we all know in Europe, has never really taken off, but it's so. I personally would love to see more allocation to that kind of stuff rather than committing to the big obvious players. But
I think that the problem with that thought is though that all of our investing should be more responsible, and it shouldn't be just managers that are new or diverse or have a focus on finding impact should get that capital. I mean, the issue isn't that GPs today are avoiding those deals because it's a diverse team or it's doing good. No one's avoiding those deals because they're doing that. They're avoiding those deals probably because they don't meet the return requirements. So just to slap something like diverse on the name or climate or whatever doesn't help. We need to make all the investments more responsible as we make them, not try and find new ways to raise money, because that's greenwashing in my mind.
Yeah, and I think you're absolutely right. I'm not suggesting that it's interesting how the lights go on when I move. It's this is not we're not talking. I'm talking about greenwashing, as in on the public side. There's a ton of just slapping on the label. All I'm saying, talking to LPs, there isn't a. You guys may be incredibly forthcoming with your GPs in driving this. We don't see that so much, despite the fact that we do it. I mean, I'm sorry, just as.
Yeah, I agree with that.
So that's all.
Yeah, but Dick, there's also reason to that. We're being approached multiple times by impact funds, newly managers, and that's a challenging. It's a new manager. There's no track record that you can validate. So, but I'm with you. Yeah.
Greg, if you're still there, just final thoughts from you. How are you preparing for the next cycle of prosperity? Which decisions are you taking today to be successful in 10 years from now? Either you or Marc, we can.
Sorry to interrupt, Catherine, but I really need to go. So I just wanted to thank everyone and the people we have just met today and everyone listening. Thank you for having me, and I wish you a great rest of the day.
Well, since you're still here, maybe there's still room for you to share your final thoughts about the direction the private equity industry is going through. Where do you see the industry in 10 years from now, and most importantly, where do you want to see it?
I'm going to leave it to Marc and Dick, because I've been holding my next call for a while. So sorry about that, but I'd be very happy to come to Nyenrode and to a castle. I cycled by it the other day, actually, even. So I'd be happy to come there for another one.
Thanks a lot for joining, Ludo.
Thank you.
All right, Marc, I think you're the last person who hasn't shared the final thoughts yet. So just back to the question, how your company is preparing for the next cycle of prosperity, and in general, where do you see the industry in 10 years from now?
So particularly with private equity, it's a long-term asset class, and we have a long-term view. I wish I could, but we cannot time the market. So that means we want to be in the market constantly. I think the best and the only way for us, but for a lot of institutional investors, to time a piece of the market is via co-investments. That's less of a blind pool. You can see upfront what's the quality of the deal, what's the quality of the manager. But the majority of what we do is long-term view.
Well, thanks a lot, everyone, for joining today and sharing your vision with us. And of course, thanks a lot to all the participants who dialed in, and to everyone. Just feel free to keep an eye on our future events on our LinkedIn and Facebook pages. And we all hope to see you one day in this very audience during a physical event. But until such time, stay healthy and stay safe. Thanks, everyone, for joining.
Thank you.